the entire Treasury debt spectrum. That's how if they actually do go through with that, which is lunacy. First off, I don't think the gold's even there, but even if it was, I mean, it's complete lunacy because you're taking the ultimate real asset and putting it into the ultimate unicorn asset, whatever you want to call it. But that would require the Federal Reserve to revalue the gold, wouldn't it?
Yeah, they would.
Because if they use it as collateral, they're not going to use $42.50 or whatever it is that's on their books. They're going to use $27.50. If they turn around and sell gold to raise capital to buy Bitcoin, they're not going to sell it at $42.50. They're going to sell it at the current market price. I think that's the mechanism. If gold does get revalued by the Federal Reserve, that's how it'll be done. Just my guess.
Using gold to back Treasury debt would be impractical, requiring the Federal Reserve to revalue gold from its official $42.50 per ounce to its market price of around $2,750. If the Fed were to sell gold to raise capital for Bitcoin purchases, it would do so at the current market rate, not the outdated book value. This approach is seen as unrealistic, raising concerns about using a tangible real asset like gold to support speculative digital assets. A well-known financial analyst and commentator, BillHolter, explains that the silver market is much smaller than gold's, but a silver default would trigger a rapid reaction in the gold market. The financial system operates on an inflate or die model, where continuous debt creation is necessary to sustain the Ponzi-like structure. As money supply grows much faster than GDP, this fuels inflation and increases pressure on scarce assets like gold and silver. If gold demand surges and confidence in the system breaks, it could destabilize the entire derivatives market, impacting commodities, sovereign debt, and equities worldwide. BillHolter highlights that silver is naturally mined at a ratio of about 10 ounces for every 1 ounce of gold, but historically, its market ratio has been much higher. For centuries, the gold-to-silver ratio was around 16:1, partly due to the inconvenience of transporting large amounts of silver compared to gold. The U.S. Constitution set the ratio at roughly 15:1, while today's market ratio is around 88:1, reflecting modern valuation trends rather than historical or natural supply ratios. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
Yeah, and I mean, my thought process with gold and silver, the market is so much smaller. It's probably not even a tenth of the gold market. I've all along called silver the fuse to the golden nuclear bomb. You cannot have silver go into a default status and gold ignore it. I mean, it would immediately be followed by the gold market. You'd have buyers left and right. Let me just talk about inflate or die, Richard Russell's famous saying. From a debt standpoint, because it's a Ponzi scheme, you have to continually create more debt to feed the Ponzi monster. If you don't feed the debt, then the debt collapses. So they're going to feed the debt. But when you feed the debt, what you're doing is you're expanding the money supply. So if money supply is going up 5%, 7%, 10, 11% per year, yet gold and silver production is static or slightly declining. What's happening is, it's the classic, too many dollars chasing too few assets. And it's that way, it's that way system wide, because GDPs are only growing worldwide at 2%? But yet money supplies are double, triple, quadruple that just to keep that 2% growth. So it's a dangerous situation. And like you said, when gold blows, confidence breaks, and that will literally blow up the entire derivatives complex across the board, which includes all sorts of commodities, all sorts of sovereign treasuries, equity markets across the world. The derivatives market gets taken down when gold becomes unavailable, to deliver. Silver comes out of the ground at just under 10 ounces for every 1 ounce of gold. So God's ratio is, let's call it 10:1. Man's ratio right now is 88:1. For hundreds and hundreds of years, it was 16:1. So if God's ratio is 10:1, why did man settle on 16 to 1. And that's pretty simple because years ago, if you were going to transport capital or pay, you had to transport the metal. And because you had to transport 10 times as much silver by carriage, by horse, by whatever, man discounted silver because of the inconvenience. And I believe in the Constitution, the U.S. Constitution, it's 15 to 1 or 15 and a fraction to 1. And the world settled on 16 to 1, basically to compensate for the inconvenience of having to transport 10 times the weight, 10 times the size of what you could do with gold.
In a crosstalk with Andrew Maguire, BillHolter points out that silver's price has been suppressed for over a century, dating back to the late 19th century battle between gold advocates and silver producers. Silver has numerous industrial, technological, medicinal, and green energy applications, unlike gold, which is mainly used for jewelry and reserves. If silver suddenly rose to $200 per ounce, many industries relying on it would struggle, potentially leading to widespread cost inflation and economic disruption. Moreover, BillHolter exposes that in the ultimate financial crisis, gold could be priced at $10 per ounce on paper markets with no buyers, while physical gold trades at $100,000 per ounce with no sellers. This scenario would emerge if fiat currency is perceived as worthless, making gold holders unwilling to exchange tangible assets for depreciating money. As my late partner Jim Clare argued, a contract that cannot deliver its underlying asset has zero value, meaning paper gold markets could collapse while physical gold becomes unobtainable. Now, let's get back to the interview.
Because there's been a concerted effort for 100 years to suppress the price of silver. Actually, you could go back to, I think it was 1897 in the U.S. when there was the big fight between the East Coast, the gold people, and the Western markets that were digging up a lot of silver. It goes back. So it goes back 125, 130 years. The price suppression. At this point, think about the uses of silver. There's so many uses. There's industrial uses. There's technological uses. There's medicinal uses, and now we've got the green energy uses. So there's so many more uses for silver, and there's almost no uses for gold other than jewelry and reserves, bank reserves, or individuals holding it. So there's so many uses for silver. What if you woke up tomorrow morning and silver was $200? What would happen to a lot of the products, a lot of the uses that are in place right now? What would happen to those? Some of those, probably many, maybe more than half, those uses, the model wouldn't make sense. That would bleed through to the entire system, where you would see an inflation of all sorts of goods in all the uses for silver. Would that upset the whole system? I don't know, but I know it would certainly upset a lot of industries. Yeah, which leads to the final act, if you will. And this is something my partner, Jim Sinclair, he passed away a year and a half ago. He talked about the potential of, in the absolute end game, you could see gold at $10 an ounce offered on COMEX and no bids, and $100,000 bid in the cash markets, but no offers. That we would get to a point where no one would release gold, no one would release silver for any fiat price, because fiat being viewed as nothing. You're giving something away for nothing. And he explained this, and he would ask the question. He would ask, what is the value of a contract that cannot perform? And the answer is zero. So, that's how he got to that thought process. And it does make sense that if if you could buy a gold contract, but you're not going to be able to convert it into gold, why would you buy it? There's no value to it.
The growing disconnect between paper and physical gold, combined with persistent silver price suppression and reckless monetary expansion, highlights the fragility of the current financial system. As inflation accelerates and confidence in fiat currency erodes, scarce tangible assets like gold and silver may become the ultimate stores of value. Investors and policymakers must recognize these risks and prepare for a financial landscape where traditional assumptions about money and value could be upended. How would a collapse in paper gold markets impact global financial stability? How can individuals protect their wealth in an environment of increasing monetary uncertainty? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.